In the world of accounting, numbers tell the story of a business, but ethics ensure that story is truthful. Accounting isn't just about crunching numbers or preparing reports. It's a profession built on trust, transparency, and accountability. Investors, regulators, clients, and the public rely on accountants to present a fair and accurate picture of an organization's financial health. When ethical standards are compromised, the consequences can be severe. Financial misrepresentation, legal penalties, loss of public trust, and even company collapse can follow. High-profile scandals like Enron and WorldCom are powerful reminders of how unethical accounting practices can destroy reputations and entire organizations. Ethics in accounting is not just a guideline, it is the foundation of financial credibility and professional integrity. Accountants often face situations that test their moral judgment and professional ethics. Understanding these ethical dilemmas is the first step toward handling them responsibly and maintaining trust in the profession. One of the most common challenges is pressure to manipulate financial data. In competitive business environments, accountants may be pushed by management or clients to adjust figures to meet targets or attract investors. This can include inflating profits, hiding losses, or misclassifying expenses. While these actions may seem minor at first, they can quickly lead to serious ethical violations and legal consequences. Conflicts of interest and confidentiality issues are another major concern. Working with multiple clients in related industries can create situations where objectivity is challenged. At the same time, mishandling sensitive financial information can result in breaches of confidentiality. Upholding honesty, impartiality, and discretion is essential in navigating these situations with integrity. Not all ethical dilemmas are clear-cut. Accounting often involves complex regulations and judgment calls where the right decision isn't always obvious. In these gray areas, accountants must rely on established professional ethics codes and sound moral reasoning to guide their actions and ensure their decisions remain ethical and responsible. Trust is the foundation of every strong client-accountant relationship. Without it, even the highest level of technical skill cannot sustain a successful partnership. Transparency and honesty play a crucial role in building that trust. Being open with clients, even when delivering difficult or uncomfortable news, strengthens professional credibility. Clear communication about financial risks, errors, or compliance issues shows reliability and earns long-term respect. Protecting client information is equally essential. Accountants handle highly sensitive data, making confidentiality both an ethical and legal responsibility. Secure data practices, discretion, and respect for client privacy are critical to maintaining confidence and trust. Consistency in ethical behavior is what truly solidifies trust over time. When clients see accountants consistently uphold ethical standards and refuse to cut corners, even under pressure, they are far more likely to remain loyal and confidently recommend their services to others. Ethics and compliance go hand in hand in the accounting profession. Accountants are legally and professionally required to follow standards and regulations that promote fairness, accuracy, and transparency in financial reporting. These responsibilities protect not only businesses, but also investors, regulators, and the public. Following professional standards is a critical part of this role. Frameworks such as established accounting and reporting standards exist to ensure consistency and reliability across financial statements. Adhering to these principles helps prevent errors, fraud, and financial misrepresentation. Accountants must also understand and comply with legal obligations related to taxation, auditing, and corporate governance. Staying informed about changing laws and regulations is essential, as non-compliance can result in penalties, legal action, or even the loss of professional licenses. Beyond individual responsibility, accountants play a key role in promoting a culture of accountability within organizations. Encouraging transparency, supporting ethical reporting practices, protecting whistleblowers, and prioritizing ongoing ethics education help reduce risk and strengthen an organization's credibility and reputation. Upholding ethical standards in accounting delivers long-term benefits that go far beyond simply avoiding penalties. Ethical behavior strengthens both personal credibility and organizational success, creating value that lasts over time. Accountants who consistently act with integrity build strong professional reputations. Trust earned from clients, employers, and peers often leads to better career opportunities, professional growth, and long-lasting client relationships. A reputation for honesty becomes one of the most valuable assets an accountant can have. Ethical practices also support sustainable business growth. Organizations that prioritize transparency and accountability are more attractive to investors, partners, and stakeholders. Over time, this commitment leads to greater financial stability, reduced risk, and long-term success. Ultimately, ethical accounting benefits society as a whole. When accountants uphold integrity, they help maintain public confidence in financial systems. This trust promotes fairness, accuracy, and economic stability, strengthening not just individual businesses, but the broader financial environment. Ethics in accounting is more than a professional requirement. It is a moral compass that guides every financial decision. Accountants influence more than balance sheets. They help uphold the trust that supports entire economic systems. By practicing honesty, transparency, and responsibility in every aspect of their work, accountants protect the integrity of their profession and contribute to the financial well-being of society as a whole.